Right, yeah, taking a look. All right, well, we're already ready to go here. Here are futures for you. Dow down 107, NASDAQ is down 50, S&P is down 13 in the pre-market. Let's pull up the 10-year Treasury yield. We are now a little over 15 minutes away from the December jobs report. So here are the expectations. 170,000 non-farm payroll jobs expected to be added to the economy, and that did tick up a little bit overnight. The unemployment rate expected to rise to 3.8%. Let's bring in Making Money with Charles Payne, host and author of Unbreakable Investor, the man, the myth, the legend. Charles Payne is here on set. So, you know, we were just talking in the break about the revisions and how we keep getting a revision every single month. So you're expecting
and revisions are natural, but the revisions are always the actual number was a lot lower. And, you know, it's one thing to say, listen, everyone's losing faith in government data. For instance, the JOLTS report, the survey, only 30% of respondents even fill out the form anymore. That's happening across the board with all of these things. That's why even there's some talk about maybe the household part of this number being more legitimate than the establishment part. Be that as it may, though, this falls on Wall Street, right? These are analysts. This is what you do. Okay, we're not saying you're going to be right, but why did you miss every single month, shattering the record? What the heck was up? Was the fix in or not? And, you know, I mean, honestly, was the fix in or not? And then, of course, the way it's articulated. So we expect 110,000 jobs. We got 120. It was a robust number. It was strong. It was amazing. I mean, it was driving me nuts. It just drove me nuts every month last year because, you know, half the jobs were leisure and hospitality. The other half were government jobs. And then the more important parts of it. It's a 25-page report. There's some nuance to this thing that's really, really important. But it's interesting. You were bringing up before this the yields now, because this 4% is the key. For that 10-year,
we're
right?
just underneath it, yeah.
We're just underneath it. One of the hot things on the street right now, and I sent it to your producers, but I sent it late. There's a big bet someone put down on the yields moving today. It's an options bet.
Up or down?
Spiking.
Okay.
$600,000 bet. If the yields spike this morning to a certain point, they'll make $10 million. And when you see something like that,
we're at 4%. I missed
right. But they spike around let's say 4.15, 4.16. The person who made this bet will make $10 million. And it's interesting because you always say, you know, that's a really, you know, that's a really good. I'm looking for the right word without being censored here, right? It's a hell of a bet. So,
just be yourself.
All right. Conversely, though. You have to also say, why did Jay Powell take that victory lap?
Yeah.
He didn't have to.
Right.
What was it, and why all of a sudden a sense of urgency from the Fed? You know, you always believe that the Fed has insights that none of us have. You want to believe, I mean, listen, they've got, first of all, they got all the PhDs. But no, they have all this access to all this information coming down the pike. You got to wonder, and the last main thing that was standing was the jobs report, which is a late cycle indicator anyway. So it's going to be interesting to see what happens here. The other things I think that are intriguing, we just had up on the screen, wages, right? So job leavers are now getting far less money than job stayers. All of them are coming down. Participation obviously is going to be really, really important. And also, if we take out, and I think we've got this chart too, let's say we were to take out the jobs number, if you take out healthcare, government, and leisure and hospitality, the job number has been flat since August. We haven't created any new jobs in this country. We haven't netted any new jobs. And all of those jobs, for the most part, are either powered by government spending or, in the case of leisure and hospitality, the lowest paying jobs out there.
I'm so glad you brought that up because there was a deep dive into the job numbers at the beginning of the week by the Wall Street Journal at the editorial section, and it looked at where the jobs are being created. Guess where they're being created? Government, social services, and healthcare. Yeah. What does that tell you? It is government spending on migrants, government spending on welfare, government spending on homeless. I mean, that is where the money is going,
right.
You know, where our money is going. So these really aren't quality jobs, the types of jobs that you want to see that would actually boost the economy.
It's not organic. It's not organic growth that we really, really need, to your point, to have true organic prosperity.
Yeah, I mean, also, too, really good. I do want to look at mortgage rates really quick because you brought up Powell, and I want to get your take on this with Jerome Powell because the 30-year actually ticked higher for the first time. It's been down for a while. Now we're at 6.62%. Obviously, the housing market is something that is near and dear to my heart, but the journal says a key factor that's pulling these rates down has been Treasury yields, how that extra differential has been shrinking for 8 straight weeks.
Right.
So it's an interesting dynamic here.
1/6 of the difference is because of the yield, the spread on the yields between the. But, you know, I think one of the things that we learned last year is that Powell and the Fed only have so much control over yields in the first place, right?
True.
I mean, look at all the things that started influencing it. Even as not as equal but close, our spending, these auctions. Remember, this rally actually began. The market actually rallied. We bottomed on October 26th, but I think the rally picked up speed when Janet Yellen, the Treasury Department, put out their schedule of their auctions. And they shifted off of the notes and bonds and more to T-bills. Because, you know, the onus is if you can't get a buyer for these bonds, you have to hike up the yield. So if the Fed's not buying, if Japan's not buying, if China's not buying, and it's just really professional investors who are buying, they're going to drive a hard bargain. That means yields will go up. So for her to circumvent that and still fund this big government spending, they put more onus on these Treasury bills. Now, here's the problem with that. These bills have to be paid quickly, right? They're bills, they're short-term lending. That means the taxpayers paying all this money over and over again instead of borrowing money long-term. So the whole thing got screwed up to the point where the Fed doesn't have nearly the control that it once had over yields in the first place.
That's interesting. Well, obviously, we've got 12 minutes to go now, 11 minutes to go until we get these numbers. You're going to be with us for the job.
I'm ready. I'm buckled
numbers.
up. They did promise me a drink, but I'm
non-alcoholic, of course. But, yeah, so you're going to stay with us for the rest of the hour. Obviously,
Okay.
our jobs panel is going to be joining us after a quick commercial break.